Welcome to the Train2Invest webinar. Today's topic is stock investing myths. Disclaimer. Examples used in this webinar are suggestions and not recommendations. These suggestions are time sensitive and for educational purposes only. By continuing to watch this webinar, it is deemed that you agree to the above. Crowd reaction. For many individuals, any discussion about stock trading and the stock market creates fear and doubt in their mind. Why is this? Fear associated with stock investing paralyzes most individuals. It is amazing to see how people are extremely successful in their careers, businesses, etc., become so fearful when it comes to investing in stocks. There are many false assumptions or myths that are common when talking about stock investing. Naturally, this fear is constantly fed by the financial services industry, so that you will continue to pay their hefty commissions, regardless of their track record. Don't let these stock market myths stop you from investing. Distinguish fact from fiction. Let's debunk the major myths. Myth number 1 states that stock investing is form of gambling. Question: why was the stock market created? Answer: it was created to raise capital for companies to expand. Example: let's say ABC company was in the oil rig building business. It has an opportunity to drill in the North Sea. To do so, it needs a specialized oil rig, which will cost $1.5 billion to build. ABC company has approximately $250 million that it can draw from its cash account. Where will it go for the remaining $1.25 billion needed? Banks will not lend ABC company the $1.25 billion because they will not accept the risk, and regulators limit their ability to accept such huge exposure to one company. Risk? Yes, what if the oil production is slow? How will the repayment of the loan be made? However, the banks may be interested in debt financing such as bonds, assuming that they are comfortable with ABC company's risk. A group of, say, 10 banks may be willing to underwrite up to $250 million, with each bank being exposed to $25 million of ABC company risk. So far, we have accounted for $500 million, $250 million from ABC's cash account, and $250 million from bonds bank debt. For the remaining requirement of $1 billion, ABC Co. will likely issue shares, let's say at $10 per share. That is, 100 million shares to the public. 100 million shares at $10 per share generates $1 billion from the market. Why would the public buy ABC company shares? Based on one's own research, the assumption is that the North Sea rig will hit a gusher and generate lots of profit for ABC company. In that case, the $10 ABC CO shares will increase in value to, let's say, $20 per share, which will give the investor, who took a risk, a 100% return on his original investment. While a 100% return is an unlikely scenario, the point is that investors may get a higher return from stock market investments than in any other form of wealth building strategies. Myth number 2 states that stock investing is extremely risky. Everything in life involves risk. For example, with marriage, there is the risk of divorce. The mitigating factor would be that there is the option of seeking counseling. With driving, there is the risk of meeting with an accident. The mitigating factor would be the purchase of insurance. With buying a new car, there is a risk that it may be a lemon. The mitigating factor would be the warranty that comes with a purchase. With stock investing, there is a risk of loss. The mitigating factors could be several strategies that will be discussed later. With any risk, there are numerous mitigating factors that may eliminate that risk totally or substantially reduce that risk. Myth number 3 is that cash is king, which seems like a safer option. Inflation kills the value of money. The value of savings will quickly be depleted by inflation. For example, assuming that inflation is running at 7%. The cost of goods would increase by 7%. However, your cash in the bank gets a return of 2.5% in interest. This means that the value of your money is declining by 4.5% per year, that is 7% less 2.5% equals 4.5%. If inflation jumps to 7.5%, the value of your money is lost within 10 years. Myth number 4 states that you need to have a PhD in finance to understand investments. This is the myth propagated by the financial services industry, an industry which is protected by politicians. Remember, the financial services industry supports politicians in their election campaign funding. The ability to make you think that you need experts to invest your money for you implies that you are not too smart. The investing language that they use on you is to create doubt about your ability to do it yourself. This creates fear about your skill set, that is, you lose confidence about your ability to invest in the stock market. The fee income structure is a huge incentive for them to do it for you. So they come across as experts. That's the reason they have certified financial planners who are really salespeople, are made to look like experts. Fact, anyone who has the knowledge and the discipline can invest in the stock market with confidence and consistency. Myth number 5 states that you need plenty of money to invest. Every Canadian that has an RRSP, TFSA, etc., which is managed by mutual fund companies, are already invested in stocks. The only difference is that you are not aware of where your money is invested in. You can open an account with $50. Ask yourself, how much has the mutual fund company made for you? What did you pay that fund for the return generated? Is it negative? Myth number 6 states you cannot beat the market. Timing the market is not possible, and those individuals that do accomplish this feat will not have their luck last. Don't bother trying to outsmart the stock market, just accept that you aren't going to outsmart the millions of other investors who believe the stock market timing isn't beatable. However, the stock market can be beaten in terms of performance. Investors and traders do it every year, and some do it every year consistently. Most investors simply don't have knowledge and discipline to actively manage their portfolios, and thus do not have the ability to outperform the stock market over the long term, which is why this myth refuses to die. Myth number 7 states that stock investing is a zero-sum game. What is a zero-sum game? It means that when one investor loses money on a stock, someone else has gained that money. In essence, it is the belief that money never grows in the stock market, but is simply transferred from the ignorant investor to the savvy investor. The stock market is not a zero-sum game. What allows the stock market to go against this belief is that over the long term, investors can all profit if the stock market is constantly going higher. If you invest for the long term, you will be profitable, as will all other investors, since prices are continuously going higher over the long term. Why? Imagine the wealth being generated in the global economy, for example, in South Korea, China, India, Vietnam, etc. The global wealth, measured by GDP, is about $85 trillion. Myth number 8 states that stock investing is day trading, meaning that you must be on the computer 24 hours, 7 days a week. Day trading is a form of gambling, as day traders tend to trade for 8 hours trying to catch penny movements. Real investors place their orders on a smartphone if they are not near a computer. For example, buy order is placed on your account at any time of the day or night, and if the order is filled during the trading day, an alert informs you that your order has been filled. You then place a sell order via your smartphone. If the sell order is filled during the trading day, you will receive an alert stating that your sell order has been filled, and the money is transferred into your account. You do not even have to be on a computer, all of the above can be done via a smartphone. What is wealth management? Wealth management is a topic that many of us get frustrated with. Why? Because very often we have tried to build wealth but have failed miserably. Unfortunately, most individuals/families have no idea of what wealth management is all about. What are the reasons that has caused so much grief? Please visit www.train2invest.com, Blue Arrow, and download the free ebook The Stock Market: The Untold Story for further details, or call 20441499106, Red Arrow. Please subscribe and hit the bell for updates. Thank you.